Okay, everyone, let's go ahead and get started. Today we're pleased to welcome Robert Deel into the webinar room. This is the first time that Robert's actually come into our webinar room, so we're very excited to have him here. Again, my name is Kelly Clement from MetaStock, and I'm happy to be here to introduce Robert. So if you've been in our webinar room before, you know what comes up first. So we actually do need to start with a disclaimer before we get started with the presentation. So I'm just going to read through the disclaimer and then we'll get started. Today's demonstration is designed to instruct you on using MetaStock and accompanying software plugins and are not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So, okay, with that done, let's introduce Robert. You're not here to listen to me read disclaimers. You're here to listen to Robert talk about trading. So, we're excited to have Robert. I've heard Robert speak many times in my career here at MetaStock, and I always love to listen to Robert. He's got a great energy about what he's talking about. He's very enthusiastic. But best of all, he knows what he's talking about. He really does understand the markets, what they're doing. He's spoken around the world. He's traded the markets. He trades the markets. And it's something that I think you're really going to enjoy. He runs a trading school. It's called tradingschool.com. You can visit his website and learn more about him there. So I know he's going to go into some of his professional background, so I won't spend a lot of time talking about it. I'm going to go ahead and turn the time over to Robert and let you hear him some. Robert, over to you.
Well, welcome to the webinar today, everybody. Again, my name is Robert Deel. I'm an internationally recognized trading expert in the markets. I've been trading for over 31 years. And today we're going to talk about the current conditions of the market. And again, I'm coming to you from a perspective of a trader. Now, many years ago, when I first came into this business, and it is a business, I came in as an investor. Well, then 1987 came along, and I learned really quick that being an investor could be hazardous to your wealth. So from that day forward, I definitely was in the camp of trading. I found that I had much more risk control. And I am a user of MetaStock from way back. So we are going to talk about things in MetaStock, but it's basically going to be pointed towards how I go about trading the markets. Well, I have to come out with a disclosure myself, so really quickly let me go over this. The content provided is of an informational nature and is to be used for educational purposes only. The illustrations provided are strictly for example and do not represent a recommendation of any kind. This presentation is not a solicitation to buy, sell, or recommend any securities. Trading has risk, like we didn't know that, right? Use only discretionary trading capital, and success will vary on an individual basis. No one can guarantee a positive outcome of any strategy. The information in this presentation, produced by tradingschool.com, is designed to be used by traders and aggressive investors. And here is where I'm actually broadcasting from today. This is my office. And later I'll talk to you about my little dog that's with me all the time. Her name is Maddie. And we'll talk about the pros and cons of having animals in your trading area. Anyway, I want to get right into this. I want to make it very clear that you are not trading against each other. You are trading against professionals whose job it is to relieve you of your capital. And if you don't understand how the markets work and how to trade, you're at a significant disadvantage. All of the formulas and all the software in the world are not going to help you unless A, you can control your emotions in the market, and B, you have a trading technology that is on par with who you're competing against. Now, the bottom line here is that you have to trade like a pro and think like a pro if you want to be successful. the really funny thing here is I'm looking at this slide. I note how clean my desk is. It's kind of like I knew that I was going to have the picture taken, because I can assure you my desk is typically not that clean. But anyway, I trade off of a 4-monitor trading array. I am a technical trader, always have been. And with that, let's go further here. I want to show you something, because a lot of people believe that success is based on technology, that the more technology you have, the faster the computer, the bigger software, the more successful you're going to be. That simply isn't true. In this case, I put up 5%. Now, what does 5% mean? 5% is ostensibly telling you that in the trading array you see before you, which is a real-time trading array, I spend 5% of my time here. Where's the rest of my time? I spend in MetaStock. 95% of my time is spent on analysis and running templates and explorations and some of the things that I've designed. In fact, I don't know if you've, some of you that may be new to MetaStock, if you look in the explorations, you'll find, I believe it's 3 different explorations that have been in MetaStock for many, many years. One is the Deel momentum filter. So it's with a lot of pride that I say that I've worked with MetaStock for a long period of time. In fact, I joke, I say that I was using MetaStock before MetaStock was MetaStock. So 95% of my time is spent on analysis. Now, here's another thing. There are many different types of approaches to the market. And if you really boil them down over the years, what you find is that it really boils down to 3 specific approaches. The one that I have decided is more valuable to me, and again, I've been trading for over 31 years, the approach that I use is known as a top-down approach. And ostensibly, a Nobel Prize in economics stated that as much as 80% of a stock's trend was due to the sector's influence on that specific stock. Another factor that influenced it is the stock's trend was the market itself. And underlined, you'll see the word correlation. That's very important, because I like stocks and ETFs and things that are highly correlated to the sector and the market. I am not trying to get delta neutral or some of the other strategies that are trying to decouple from the market. Because, why? Because I'm a trader and I'm looking for that kind of momentum that I'm only going to find in highly correlated trading vehicles. So, if we look here, here's a simple example of how this works. The first place that I begin my analysis is on sectors and indexes. Then that leads me to the market, which leads me to trading vehicles, and those trading vehicles can be stocks, ETFs, indexes, or options on all of those. I trade multiple time frames, and again, where do I spend 95% of my time? It's in MetaStock, running my scans, my explorations, my templates, and my custom indicators to find the best trading vehicle. And I'm going to tell you something, it's probably not a new revelation, but in my 31 years of trading, I'm going to tell you that the last few months have been one of the most difficult trading environments that I've seen in a very, very long time. Part of that is because the trend dynamics or the structure of the trends have changed a great deal. And we'll get into that as we go forward here in the presentation today. Now, again, back to the theme of what we're doing. We're looking at tops-down analysis. So here I have a list of various indexes which represent certain sectors. For example, you can see here retail, you can see the biotechs, and I have gold in here, as well as the consumer. So I'm looking overall at all of these sectors and I'm trying to find a trend. Now, I'm going to do this in 2 ways. First, I'm going to scan and look in MetaStock, which I'm going to show you. And then if you remember back to the still shot that I showed you of my 4-monitor trading array, to my far left, all of those different charts are in fact sectors set up. And all I have to do is glance at them and I see what the trend is. Now here we see 6 individual indexes that represent sectors. We have the consumer, the retail, there's drugs, healthcare index, oil index, and gold, just to name a few. What I'm doing is I'm sitting here and I'm looking at the current situation. I scan from left to right on the chart. I see what the trend dynamics are of the individual indexes that I'm looking at. I see if there's any tradable chart patterns, and where I am going from left to right currently. These charts are fairly well up to date. I think this is back in around September the 1st here when I did these original charts. I'm going to tell you that today I downloaded everything and we're going to go over the absolute close today on the S&P and the Nasdaq. We're going to talk about various things that are reflective of today's current markets as well. So anyway, the general gist of this is pretty simple. I want to find out if I'm overbought with some kind of chart pattern, and right here you see a small, or what we call a micro head and shoulders pattern right here at an overbought situation. When I'm looking at trading vehicles, I'm looking for 2 things initially: an overbought situation and an oversold situation, and then the trend sort of in the middle. Those are the 3 things that I'm consistently looking at. All right, if we look at all of these charts, they pretty much have the same thing in common. They've run up and they are beginning to pull back. And that's across many different sectors. You get pretty much the same thing. Now the next step, after you've analyzed your individual indexes or sectors, you want to look at the market itself. And this is a current chart of the S&P 500. Let's get into this, and first I want to point out a couple things that should be obvious to those of you that are actively involved in the market and you understand technical analysis. The first thing you need to know is that there are 2 camps of technical analysis now. One is the classical, or people that look at very large time frames, extremely big chart patterns. Well, that's not me. I'm in the second camp, known as strategic technical analysis, and there is a very big difference between a strategic technical analyst and trader and someone who is a classical interpreter of technical analysis. For example, right here, going into this was no surprise. My students, as well as many people that I talked to in the industry, we knew this was a double top. However, ladies and gentlemen, this isn't just any double top. This is known as a type 1 compressed double top. You're not going to find that information in a book of classical technical analysis. Now, the type 1 refers to the probability of this pattern fulfilling its direction, which of course, since it's a double top, it's bearish. And we get an extremely large follow through here, and trend melted down. Now the funny thing is, people that don't maybe understand technical analysis, or they have some kind of prejudice against it, they would say, well, yeah, well, this came, this stuff came in here and it went down because of the current economic events. Well, to some degree that's true. However, the formation formed out before the proverbial you-know-what hit the fan here. So trust in chart patterns, but understand that there's a difference between a type 1, a type 2, and a type 3. Type 1, higher probability, type 2, second, and type 3, of course, third. All right, so we have our double top. We came down. What into? Essentially, we came down into a double bottom pattern here. Big decline, long downward trend, and those of you that use put options, or those of you that short, had a wonderful opportunity here to make a substantial amount of money, and this was just a freight train going down. The shocking thing that I find out in working with thousands of people over the years is that very few people learn how to short. I'm going to be blunt with you. I don't think you have a chance of a snowball in the place of eternal punishment of being consistently successful unless you know how to trade both long and short. Whether you're using the shorting strategy or whether you're using a put option, you definitely want to trade the downside. Now, why? I want you to write this down. Because markets and stocks fall 67 to 80% faster than they rise. Let me repeat that. Markets and stocks fall 67 to 80% faster than they rise. Once you understand that, you will see that the implosion factor of a stock, which you can see here, which is represented by, of course, a market, the trend is extremely dynamic, and it's really coming down, and it's literally lower lows, lower highs, lower closes. It's just a freight train going down. So this was a tremendous opportunity. Unlike some people who only think long or going up, that's great, but you don't always have a market that goes up consistently through time. There are a lot of times when the market pulls back, and it pulls back dramatically, and we're in one of those situations now. Let me continue. So we went into this double bottom pattern, and when you were down here, and on this particular day, I don't remember what it is, but on this particular day, you can see that it was a very large high-low range bar with a close to the high above the midline of the high-low range of that price movement. That was an indication to you right there that you had a potential reversal. Okay, not only that, but the lows were pretty even here with the previous lows, making this a very good support area down here at about 1,120. All right, so we started to go up, and what happened was we were getting near an area where the beginning of this pattern started, and it failed. I want to bring something up that not many people really know or understand, and that is when you have a pattern, like for example a double bottom, there is a certain point in time in this rise where there's a high probability for that to reverse. In other words, the influence of the pattern itself disappears, and then traders start to sell that rally. All right, that's one. The second thing is one wants to look at this as a rising trend from this low to this point, and from here to here basically you were fairly overbought, also indicating a potential reversal. So we want to ascertain kind of when approximately this double bottom or a double bottom can reverse, and we also want to look at the trend run going into this high from low here, from where it began. And this was pretty solid because again we had lots of support. Now you'll see this number 1,148.21. What this represents is a Fibonacci sequence that I calculated when we were way back up here. And this is the number that it told me basically, well, this area could be reached or breached. Well, you know what? Again, I did the calculation when the market was here. Well, it exceeded it, blasted back up, came down to another support area here, came back up, and so on. What I'm saying is right now the market is under a lot of frenetic kind of influence, and one of the things that I think would be a good idea is to look at this area, and anything above this is inherently bullish. Anything below this is inherently bearish. I want you to please write this down. 1,148.21 for the S&P 500 is an area where you sort of have price finding a equilibrium, if you will. Anything below this area is inherently bearish. And here's the other thing to note. The lows of this price activity are actually becoming higher lows. That is actually net bullish. Also, if you look here at the highs, you'll see that you have higher highs. So that's a little bit bullish. So keep that in mind. I have a range here that I'm looking at currently, and that's 1230 on the S&P. Anything that breaks about this will be really strong, and then of course we'll run into some resistance up here at about 1270. Again, this is on the S&P. Right now, what you need to be concerned about is this area right here, because the price today ostensibly touched it, and then we sold off and we closed, as you can see here, much lower. But about 1205, right around here, is very important. If you break above that, then we might have the ability to build a little bit more support right in here. All right? Let's move now to the Nasdaq. The blue moving average is a 50-day exponential moving average of the close. I use 3 different moving averages when it comes to markets and 3 different moving averages when it comes to trading vehicles or stocks. We'll talk about that in a few minutes. Anyway, you can see, of course, that price is under the 50-day exponential moving average. And again, I think even clearer, you can see that you had a double bottom pattern as well in the Nasdaq. However, there's a big difference here, and I don't know if a lot of you have caught this. What you have is 2 islands. You initially had the double bottom pattern, and then you had an island reversal. Now you can have an island without an island reversal. This reversed to the upside, so therefore it's an island reversal. The top part of the pattern after the gap in here is also an island, and this reversed to the downside. So you've got essentially a breakaway gap and an exhaustion gap in here. Where do islands typically take place? Well, normally, folks, they take place at tops and bottoms. It's rare to have an island form in the middle of price behavior. So that in itself is somewhat bullish here. Now we have a couple things that I want to point out. One is the area on the Nasdaq of 2,427.39. I'm a little anal, so I go into exactly the numbers. I don't round things out typically. Anything above this, and this is today's price action right here. So anything above this number I see as being bullish. There's a lot of crazy activity in here. In fact, if there was a little bit more space in here, we would actually call this Crazy Ivan, which is a term that we apply to chaotic price behavior that has no sense of trend direction. Right now, after this drop, and certainly after this reversal off of this bottom, trend became very difficult to ascertain, and we're just bouncing around in here literally from one day to the next. Now, bearish ostensibly is anything below this number of 2,427.39, and in particular 2350 is really important. If 2350 is taken out, then we could go substantially lower, certainly down to, if you look over here, you'll see 2300, and that's an area that could definitely be seen if we do indeed breach this support area down at 2350. So the trend right now is still bullish as far as being based on a reversal level, but as far as true trend, for example, back here you'll see a trend, it was going up, and here you had a great trend going down. Right now what you have is a flip of the coin. Today it may be up, tomorrow it may be down. By the way, I think tomorrow it'll probably be down. Now, you have to be careful. Because while I may believe that tomorrow it probably is going to trade down, that does not mean that I'm going to say, okay, that's it, I've spoken, that's it, I'm gonna short first thing in the morning. No. We all have our own analysis, but in the final end of this chapter, it's the market that tells us what to do. So even though I have an inherent belief that tomorrow the market may be down, if it's the exact opposite, I'm going to go in and I'm going to do a reverse trade. I'm going to climb on if it's real strong. I'm going to ride that trend up, watching for a potential turn to the downside as well. So again, we're all guilty of this. We come up with our own scenarios. Well, the only scenario that really counts is what the market does and what the market thinks. Here's a good example of the two conditions that I outlined just a few minutes ago, and that is an extremely oversold area. And I want to show you here in this example that an oversold area can be, as you see here, or an oversold can be a sell-off of an extremely overbought area, and this makes this potential area oversold. So obviously I'm thinking about potentially going long an oversold condition, and I'm thinking about going short an overbought condition. Now that's counter to the way most people think, but the market has a habit of rewarding people that pay attention to these rules. Extremely overbought, potential reversal. Extremely oversold, also a reversal, but a bullish reversal. So if you're dyslexic, you'll do really well in the stock market, because what you believe is bullish, the market thinks is bearish. What you believe is bearish, the market believes is bullish. And when I see and have certain setups, I will take advantage of those, and we're going to talk about that today. Okay, the negative return zone. Folks, listen up, because this is real important. A lot of people just don't pay enough attention to price structure. And price structure is key for any kind of momentum or directional trading. Here we have an example of a stock. And in fact, if you look at this, what this has a potential to become is an inverse head and shoulders pattern, by the way. I just thought I'd bring that up. So here you'll see that it kind of disjointed, the trend, the structure of it wasn't all that strong, yet people will try to trade stuff like this. Now, yeah, in an area like this, intraday, in other words, a day trading opportunity may exist, but for micro trend trading, 3 to 5 day time frame or longer, this is a fool's game to get into. Once you get into this, there's no direction, kind of like where we are now in the markets. We have a situation where we have no true trend direction yet, and most people, a lot of the institutional people that I work with or associate with, they're standing on the sidelines, and they're only participating to the amount that they have to do that right now. They're not going full in because there is no sense of direction. We have the camp of people who are big believers in buying extremely oversold markets, which are, by their estimation, undervalued, but there's no trend. And I may go along a little bit with that in certain areas, say, you know what, on a certain stock, I might pick up some of that for my pension plan, but I'll tell you what, I might do that, but I'm not going to load up big time. I want to scale into this, especially if we have a trend. And ladies and gentlemen, this is nowhere to be. Do not trade this. It's a negative return zone. And that's pretty much what should be stamped on it, a skull and crossbones, stay away. Here's another example. Here you've got stuff comes out, it's kind of trending through here. What is the first thing that you should notice about this? Well, first of all, look at how much of gaps there are in between the price range and the price activity on this. So you're going to stay away from this. This is very common in a lot of the Chinese stocks, for example, or ADRs, American Depository Receipts, that you see out there. A lot of space and gapping. Yeah, as long as it gaps in your favor, that's great. But if it goes against you, you're not a happy camper. All right? Here's a situation, though, where you had a nice trend. If you'll notice, it started to break up. You had higher highs, higher lows, higher closes, and right there was a little hint. Look at the range compression on that bar, very small high-low range. Typically that happens near areas of consolidation or in areas where you're having an overbought situation, and that's what's happened here. And another area, gap down, and again we have an oversold consolidation. However, there's no directional trend movement, and what is it? It's a negative return zone. Just stay away from it. I don't care how cheap it gets. As long as you have this kind of price structure, you don't want to come anywhere near it. Money management. There are, I would say 5 to 6 different money management strategies. One that I use, and the one's probably the most common, is known as fixed fractional analysis. It's also known as fixed risk analysis. And why is that? Because you're only putting a proportion of your overall trading capital which stays out of the market, maybe in money market or something like that. And in this case, it's an 80-20 rule, where 80% of our capital is setting aside and we trade with 20%. So basically, the higher your equity grows, the more funds are available for trading, and the more your capital system can earn. So look at this pie. Imagine you go in and you make some extra money, so this pie increases. So it's 20% now of a larger amount. So in this example here, your trading portfolio went up 20%, 24,000. Now that's $104,000 out of this $100,000 pie. And I find that that works really well to use this, because if, for example, you get into a situation where you have a string of losing trades, what will happen is, if you stick with fixed fractional, the amount that you can put into a trade decreases. So if you look at this pie here, imagine that it's only this big. So what's that mean? That means you can put, you might be able to trade, but you can only put a smaller amount of capital to work. If you truly follow this system, it's very difficult to blow your entire account out. I know some people that have tried really hard to do it, and some of them succeeded. But the idea, again, is when you're in a winning streak, that capital is expanding. You can take a little bit more off the table and put it into the trade. When you get into a losing streak, you put less in. So I think it's an excellent money management strategy for trading. Let's discuss risk management. First of all, let me ask the big question. If you put $100,000 in XYZ stock, how much do you have at risk? Answer me, everybody. Well, I hate to tell you this, but most of you probably said it's $100,000. You couldn't be more mistaken. Now, I also know why you answered that, because most of you have been trained to think like an investor. And an investor, when they go in, they put their money in, they pretty much go all in, maybe diversify it up, but they're going in, and to them, their money is at risk. To a trader would never answer this question, I put $100,000 at risk. Whether it's $1 million, $1.2 million, $2 million, $5 million, $100,000, it doesn't matter. When I put on a trade, the only amount that I have at risk is what I am willing to lose in the trade. In other words, if I'm carrying anything overnight, for example, I have a stop in place. That stop represents my maximum loss that I'm willing to take on this trade. So for example, let's say that you did put 100,000 in, but you might only have $1,000, $700, whatever your stop placement is, at risk. If you start thinking in those terms, you're going to understand that when it comes to trading, ladies and gentlemen, you are the risk. It isn't the market. It's not the ETF, and it's not the stock. It's you. You control the risk, and you also control the profitable outcome. Now, you never want to get into a position and hold it overnight, ladies and gentlemen, unless you have risk control or stop in place. And I don't care what they say. They say, well, those guys know where my stop is. Not really. They don't. Forget about that. What you're saying is if you don't put a stop in place, you want to take risk into infinity. And yeah, I guess for you, you are going to lose or have the potential to lose 100,000. But not for a trader. So I want you to start thinking in terms of, if you're holding anything overnight, having a stop in place and limiting the amount of loss that you would have in any given trade. Because once you understand that you can limit the risk on your trade, up or down, then a whole new world opens up for you. Takes a lot of psychological pressure off. Now let's talk real quickly here about past bear markets. From 74 on to the decline from 2007 where it started, that's when it actually started, November 1st, 2007, and then we ended up. I want you to notice that the more recent markets have become extremely draconian, and it's very important to be able to control risk. For example, whether it's a stop or some other kind of methodology. Or how about this? What if you looked at these numbers and instead of a minus sign, you had a plus there? Now, how would you get that? Well, simply by trading the downside. Because remember what I told you about 5 minutes ago? Markets and stocks fall 67 to 80% faster than they rise. So trading the downside is extremely important to your profitability going forward. And professionals who you're trading against, that's what they do. They trade the downside as well as the upside. Okay, now here's another reason you want to do this. Here we have a graph where we have the percentage of capital and of loss, and then the percentage of capital to recover from that loss. A lot of people don't understand this, but you need to remember this and write this down. Let's say that you're down 25%. So right here. What is it going to take you in the next trade to recover from that, not counting commissions or slippage, because that's extra money coming in here, but just straight mathematically, how much is it going to take for you to recover? Well, it's going to take you 33.33% to recover from that. Now, why am I showing this to you? There are many reasons. One is the lay public in general will wait, and they are willing to lose, apparently, 25% of on their trading capital. But they don't realize that it's going to take in the next trade 33.33% to break even. Actually more, because again, slippage and commissioned on that. So the idea of letting something go against you, like a freight train down, is a very bad idea. Because as you can see, the more you lose, the harder it is. If you're down 50%, it takes a 100% move to recapitalize yourself. Actually more than that. Now, what if you're using margin? Well, you're not down 25, you're down 50. So, boom, just like that, you're down 50%, it takes 100% to come back to break even. So we definitely want to watch out for that. Now, the other day, I heard a lady in a restaurant talking to another a gentleman there, and they were discussing how the market, recent market activity, oh, you know, it's down, but I don't worry about it because, you know, it always comes back. And, well, you know what? That isn't true. The market may be up, but that doesn't mean that your stock is participating in that rally. I know people that have ostensibly, they're still not break even from 1987, and I'm not kidding. Let's go in and look at what it really takes to recover from a loss, not the simplistic financial formula that you may hear from someone, but what it really is. Let's say that the market drops 30%. Now this is the market. Now with the market, I'm assuming that almost all the stocks are coming down. And now we want to do a calculation out in time and figure out how long it's going to take to recover what we lost. Okay, and what we're going to say is you're going to get an 11% gain. Now I'm being real generous, especially in these market conditions. You're going to make 11% per annum on that? Well, that's what I'm going to give you. I'm being real generous. And now what do? How long is it going to take to recover? Well, some people get their HP 12C calculator or financial software and they plug it in. Oh, it's going to take me just presto changeo, what, 5-6 years or 5 years? No, not even close. Because here's what they're not doing. They're not calculating commissions. They're not taking taxes into consideration. They're not looking at double-digit drawdowns. They're not looking at drawdowns or down years with 15 to 30% because, you know, you have this 30% decline. You go off in time here, and 2 years later, you may have another 30% decline. And I don't take that in consideration. Flat returns, oh, you mean we might not make much? Yeah. Inflation? Yeah. Now, if you factor in the percent gain to recover that I just showed you on the previous page, presto changeo, ladies and gentlemen, it's going to take you 13 years to recover from a loss like that. Now, let's just think logically here. If you're going to put your money at risk, please use a stop. It makes no sense to ride a winning trade into a losing trade and then compound your loss exponentially. Because if you do, you're going to end up in this kind of a situation. And then it's just, you know, by guess and by golly that, you know, the thing works out. That's not what we want. We want to limit our losses at all times. So risk management. Here we've got a simplistic example, and each one of these represents a trade. So the first trade, you got into it, immediately it went into a positive territory, you sold it, you made a profit. In fact, the way that I'm going to present this to you, you made money on each one of these trades. But I'm going to show you something that is probably happening to a lot of you out there. The next trade you put on, trade number 2, yeah, you went positive, but you also went what we call underwater. You went an underwater equity curve. You went a little bit lower, didn't sell it, that's okay, because this trade turned out. Then in trade 3, we go in here, that looked good. Trade 3 is a good trade. Yeah, I made money in that, but what happened in trade 3? You took 50% more of a loss in trade 3. Why? Well, this trade worked out, and you know what, if I'd listened to that Robert Deel guy, I'd have this stop in here, and I would have been stopped out, and I wouldn't have, you know, made any money on this thing. Okay, you are now taking 50% more risk and loss in the trade than the trade before it. The next 3 trades, positive, perfect timing, you didn't have anything go against you. However, in trade 7 over here, you took 100% more risk than you did previously. And if I see this over time, when I'm examining somebody's trading history, I can tell you, as sure as God made little green apples, that person is anywhere between 3 to 6 months from blowing their entire account out. What you want to do is have a strategy that absolutely does not allow this kind of situation to happen, continual losses in trades. You want to take it out so that your risk management levels out the risk inherent in a trade. All right, now some people believe that if they have more positive trades or winning trades than negative trades, it's going to be okay. Here we have a situation where a person flatted the trade. That's a term we use in the business, a flatted or push. They saw something coming, they got out, and it's just the commission costs and stuff. So you made money. So here was a neutral trade, lost actually a little bit. Winning trade, losing trade, winning trade, 2 losing trades, 2 winning trades, losing trade, and 3 losing trades. So you had 7 winning trades, and you got 4 losing trades. Is that good? Yeah, actually that's pretty good, except what if these losing trades here, let's back up, ended up like this, and you went back here and you actually lost 50% or more. Let me tell you something. You can have 10 consecutive winning trades in a row, ladies and gentlemen. And if you don't manage the risk on 2 of them, it's quite likely that you could lose all of the money in your account. Why? Well, normally when you win, you feel, well, let's see, the more I win, the greater I feel, and the better I feel. So what's this about margin? Oh yeah, I'll feel twice as good. Let me just stack up on the margin there. So you can see if you start using leverage, or if you don't control the losses in a trade, no matter how many winning trades you have, they're going to be offset by the losing trades. And if you look at your trading history, most of you are going to find that you're holding on to garbage, and you should have sold it unless you're in the garbage business. All right, this is what I do. This is a stop template that I have in my Trader's Edge product. And you can see here that the stops are dynamic. They're adjusted to the price. So this is a long stop. I also have a short stop indicator here. And each one of these stop dots represents where your stop is going to be. So I can go outside of standard deviation if I think there's going to be a pullback and then another move up. Or I can jump up here right close to the price action, and if this pulls back a little bit, boom, I'm stopped out, I cash out, I book the profit, and I say next, and I move on. But anything that I carry overnight has a stop on it. Here's an example of stop efficiency. Here we have a trading vehicle. We have our stop, as you can see here. And at some point, it goes down and we have a stop. However, something happens here, and the stop isn't triggered. So what we do is we record the dollar amount and the percentage change difference between the stop and the actual point where the stop was triggered. Now, what's this going to tell us? It's going to tell you how disciplined you are about cutting your losses and following your trading plan. By the way, one of the first books I wrote in this industry was called Trading the Plan, because I found that most people didn't have a plan. Some didn't have a clue. They were out there, well, let's get in, and the market's going up, so I'm going to make money. The market doesn't know or care about you or me. It's going to do what it's going to do. So if you're going to be successful, you've got to approach this from a very professional point of view. The second thing that this stop efficiency is going to tell us is how good is your stop placement and if your methodology is sound or not. For example, point number 3 here, you're trading vehicles that are too volatile, and you need to adjust your selection of your trading vehicles as well as the placement of your stop. A lot of people listen to that little pig, and it tells them, hey, let's buy this, we want to make lots of profit. And then what happens is the volatility on that is so dramatic that you don't sleep well at night. So what you want is to put on a risk management methodology that allows you to sleep well. Okay, let's go into probability, volatility, and predictability, and let's answer these 3 questions because they're real important, and I'll show you how we're going to do this in MetaStock here in just a second. First, What's the dollar high-low range over multiple time frames? If you're an aggressive investor, if you're a micro-trend trader, if you're a trader, if you're even an investor long-term, you need to answer these three questions, and you need to know the answer to them. And it's real important, as you're going to see. Number two, what's the normal average volatility for your trading vehicle over X time frames? And ladies and gentlemen, I suggest that you highly consider the ones listed here. I want you to write them down. 5 days, 12 days, 20 days, which of course would be one trading month, right? 3 months, 6 months, and 1 year. Statistically, it's not very important what happened 5 years ago. So I only look at last year's data and this year's data, and I'm constantly going forward. So as I go forward, 1 year drops away, and I'm always going, well, last year and this year. My technical indicators and my analysis are done in a 1 year time frame within MetaStock. And number three, the last question here, and just as important as the volatility, what is the trend and the pattern structure? In other words, is it a type 1, type 2, or type 3? Is it compressed? Is it expanded? Is it what I call marching ants, which are higher highs, higher lows, higher closes, or in a downtrend, lower lows, lower highs, lower closes? Here we have Amgen. This again is a current chart. Amgen, by the way, is bucking the trend. I don't know. There's something going on out there. I don't know what it is, but I can tell you there's something going on with Amgen, and I can tell just by analyzing the chart behavior that I can see that. So here we have Amgen. One of the things that I want to do is answer the previous questions, so I have devised a template that I created. Actually, it's an expert advisor. And I bring it up and it answers some of those questions. It says, what's the average high-low range or aggregate high-low range within a 5 and a 12-day period? Now, and the lowest in the same time frame. Now, why do I want to know that? There's a couple things. One, I know if I put my stop in anywhere close to $1.17 here within a 5-day frame, I'm going to get stopped out. If I go over here to a longer time frame, $12.20, anywhere in there, I'm going to get stopped out. So I have to make an adjustment on that. Also, here's the lowest price within the 5-day and within a 12-day. Okay, what else? Why would I want to know this information? Okay, we know about the stop. What else? Well, let's say that I have 3 or 4 different trading vehicles. And once I do this analysis, I see that 2 of those trading vehicles are moving at 68 cents over a 5-day and maybe 70 cents or something like that on a 12-day. You know what? I kick it out. Because when I do analysis to take on a trade, it's a combination of a trend score, a probability score, and a risk-to-reward ratio of 2.5 or greater. So is this stock that I'm going to put my money into, is it moving more than $1 across multiple time frames? And even on a year, what's the information here? Now, those of you that trade options out there or momentum in any way, shape, or form, I mean, you can understand the power of this particular what the heck is it? You're thinking here. The power of this particular expert advisor. And it has to be an expert advisor because it's designed as a table. So I know that this has a high probability of being success, and I also know where to put my stops because the normal higher range volatility of this thing won't take them out. Now, this isn't average true range. I actually like this far better than average true range. Moving along. The other thing is, if you don't already, I'm sure you are, definitely use Bollinger Bands to gauge volatility. Now, I put an exponential moving average on it to look at so that I can see the overall volatility, and it forward weights the Bollinger Band. 95% of all price activity come within the bands, and the upper band, of course, is 2 standard deviations above, and the lower band is 2 standard deviations below. I think most of you that are doing this understand that. But what you may not also understand is that this is an area where it can, once we get to the bottom of the band, okay, where is it going to move up to? First target would be the moving average. Once you get above that and move higher, what would it be? The second band. So it divides price into 3 sections. It also tells you how bearish you are. For example, here you are, you got a thumbs down with a fingernail, and it's an inverse head and shoulders pattern on top of that. So, I mean, if that isn't a long, I don't know what is. And it's coming in March, so it's not particularly bearish mode. What else? Well, most people use a 20-period Bollinger Band. What I like to use is a 20, but I find that once I screen for stocks that have really good trend, the best time period for a Bollinger Band is a 12-period exponential moving average on the band. And I think you can see how well price adapts to these to the 12-period. It's much more defined. You can see that once you touch the range, you have an ability to bounce back from the other. I'm sure you're aware of how Bollinger Bands work. But you can see that price is far more defined. Now, the key here is that you're screening for momentum and things that are actually trending really well. Because this is not going to work. In fact, I don't see why anybody would want to buy a stock that doesn't want to do anything. It just lays there. It's just like, you want something that's really moving, that's trending. And this is a way to help gauge that. For example, when you get an extrusion like this outside of the Bollinger Band, and you've screened for, again, momentum, the odds are huge that this is going to drop. Where? Back down to the 12 period, and then once if it breaks through that, the moving average, it comes down to the lower part of the band. All right, let's talk about strategy here, indicators, and price analysis. I think we're going to go a little over here. It's almost 4 o'clock. I'm probably going to go to about 4:10. I hope I can't see anything that's going on there. I hope you're sticking with me here because we've got some really good stuff coming up, and I definitely want to keep going. All right, whenever you do a scanning or explorations within MetaStock, this kind of shows you my custom scans and explorations in a little product called the Trader's Edge, which you can find on the product section of tradingschool.com. But I live and breathe by my analysis in MetaStock. And when I say live and breathe, I'm not kidding. I eat off of trading. If I don't make money, I don't eat. It's that simple. The classes that we do from time to time are maybe 2 or 3 or 4 times a year. So I'm not making my money by doing classes. I'm making my money by trading the markets. All right, here we have ABX. Now, American Barrick, this was done, I believe it was, so let's look at the chart here. We can see that we've got an overbought area up here, and we've retraced from this overbought area before. We're now breaking out and coming up. This is bullish, and of course ABX is gold. And this particular, I bring up my templates, and you can see here, there's a list of just some of them. And I click on the probability, and then I bring up my probability template. So this was done on September 2nd. I'm going to show you the reading here in a minute on today on the same stock and how it changed from bullish to bearish. Okay, so now we have MACD, RSI, 3 price rate of changes, 12, 36, and 39 period, Williams percent R, CCI, money flow, and then Bollinger Bands. All right, now here's what I've done, and here's what I do, and here's what I've done for probably 23 years. First of all, I screen for the stock, good momentum stock. Up or down doesn't matter, just it has to be strong trend. Then I apply my template and I assign a +1, -1, and 0 to each indicator. Now obviously in price rate of change, since there are 3, you're going to have the potential for a +3 if they're all pointing the same direction, which is what happened here. So I'm reading these to give me a synergistic application of indicators to tell me what's the probability of the trend direction on the trading vehicle, and in this case the trading vehicle is American Barrick, or Barrick. All right? Here's what happened. When I did that on the 2nd, September 2nd, the first score came out 6 to go long, 3 to go short. Now that wasn't a super strong reading, but 6 to go long, 3 to go short. That told you that the momentum was really strong. All right, I ran it today on ABX, and here was the score today. It's changed. Now it's +4 to go long, and then +4 to go long, and I am sorry, +4 to go short, and +2 to go long. So we had a complete shift here. What's happening is the mining stocks now are becoming more and more overbought, and what will happen very shortly is they will become much more overbought and therefore become candidates for going short. And then we'll have to look not only at the indicators, but mainly we'll have to look at the price structure to get into a trade. Some of you have mistakenly believed that the indicators are going to tell you when exactly to get in and get out. Most of these indicators are just going to tell you the trend direction. They're not going to be surgical in telling you when to get in and get out. I know this because, again, I've traded for over 31 years. I train professional institutional traders to trade from hedge funds, insurance companies, and so on, and they are looking at the price structure. So it's a combination of a score, the probability score from the indicators and the entry and exit score that they're essentially getting from the actual price data itself. So let's talk about that. Here we have price running up and what's known as a parabolic pullback. Now, obviously this is an uptrend. We want this to be taking place in an extremely overbought condition. Then we have a reversal take place. Obviously you can see that the close is lower. We have lower highs, lower lows. This also went parabolic. In other words, it's not just on the normal line of ascent. It's overbought. And this is showing you relationship that we have these lower closes. When I see this setup, I typically will go short. My stop will go somewhere up here if I were just using the price. All right, and a rounded top pattern when it starts to roll over, there's a potential short there. Also, you have to realize that when this occurs, at about this point, you could have another rounded top, so this could become a double top pattern. It's one of the things that you have to be aware of when you have this kind of price activity. Here we have a spike low reversal, and this is the trigger bar, the red bar. This is the reversal bar, the yellow, and you will note here that the majority of the reversal bar is above, above the high of the trigger bar, and that's what makes that a spike low reversal. It definitely boom, bow, takes off. However, here is a potential problem. This is great for a long entry. However, many times a spike low reversal can in fact become a double bottom pattern. So remember, in this case, this is taking place at an extremely oversold condition, and it is very uniform down. It's not sloppy price behavior. It's going lower highs, lower lows, lower closes. This is known as a delta V reversal. A delta V reversal is this: the low of that reversal bar is in the exact middle of the trigger bar. You have higher closes, you have higher highs, you have higher lows, and those closes are above the midline of the high-low range. Now, once you have that set up, that's a setup to go long. All right, back to trading. You want to trade like a pro. So let's do some applied analysis. Let's pretend here I'm going to give you all $100,000, okay? Say thank you. Okay, thank you, Robert. All right, now we got $100,000. Here's what you're going to do. On a piece of paper, put your $100,000 down, and then we're going to do 10 trades here. And when you're wrong, you're going to subtract $10,000 from this amount. So let's go. First of all, I'm going to be real good to you because I'm going to give you the trade. Everybody got in now? And at this point, you have to make a decision. Are you going to buy, sell, or hold? Well, we already bought. So the real question for right here is, are we going to sell or are we going to hold? Now, everybody out there has got a different answer. But look at what's going on. Repeat after me, everybody. I know I can't hear you, but I want to hear you, so I'm really listening good. No trend, no trade. Say it. Let's do it again. No trend, no trade. You had excellent trend, consolidation, a trend up, and then now you're in consolidation. Plus, if you looked at it from this point to this point, you are overbought. Therefore, you are more likely to turn down than to go up. Plus, you got consolidation. It could break out and go higher. It could. But in this case, it didn't. Okay, what are we going to do now? Are you going to, did you make money on it? I hope so. Here we got a situation where you have a pattern. What is this pattern? Well, some of you are looking at it and I don't see a pattern. Look at it real carefully. It's a double bottom pattern. Normally these double bottoms take place more at bottoms, but this lines up to a past support area too. So this is bullish. So you'd go long. Some of you are sitting out there, yeah, sure, sure that works that way. I'm not kidding you. That's exactly what I do. What do you have here? Well, this is a problem. First of all, it is a potential double top pattern, and it's a type 1 because we have a lower side here. But mainly, when you go into a double top pattern, you don't normally come out of consolidation like you see here. It's a rise up to that, and then it really comes down, really drops. So if you are going to short this pattern or to use a put on it, you have to be very careful because there's a lot of support here for that. In this case, it didn't hold. Now what are you going to do? You're going to go long? You're going to go short? Well, we're overbought. We had a parabolic run up. Plus, look, there's no more room up here for the thing to go up, right? So we got to go short. So let's click here. All right, now what are we going to do? Well, first of all, look back at this area right here, and you can see that there is substantial support here. So the odds are really that this is going to go higher. In reality, what we would do is just wait a day or two, but I'm not allowing that in this example. But look towards the past here, and you can see that that was the case. Now we've come down here, but we've got a gap. And do you know the rule of gap? If you don't know the rule of gaps, please get your pen or pencils and write it down. If you have a gap, the price normally moves in the direction of the gap for 3 to 5 days, normally. In this case, it blew through this support area, came down, and now we have what we call pillar bars, which are price aberrations that hold up price structure, hence their name, the pillar bar. And this is actually bullish. The markets actually get these from time to time. Okay, here you are again. We're going back up to our overbought condition, more potential for long. Now I unveiled the bad news for you. We went through all this agony figuring this out for nothing. There's not enough money in here to even consider it. So remember, you have to have a 2.5 or greater risk to reward on the trade, and you know, there's no profit in there, we don't do it. All right, real quickly, that's an open, close. So we've got high, low, open, close. Now, everybody see this? Is that a bullish open or a bearish open? Well, it's bullish open because we opened above the midline of the high-low range of this bar and very close to the top, so that's a bullish open. Now, and sure, I'll be darned, it moved up there. So now what do we have? Higher highs, higher lows, higher closes. Is that a bullish open? Yes, it's a bullish open. Now, does that mean that it has to move up? No, but it is a bullish open because it's above the midline of the high-low range of the previous bar. Now it's going up. Now we have 3 bars. Now we got a trend going on here. Now what if these are daily bars? Oh, is that a bullish open? Be careful. Yeah, it's bullish because it's still above the midline of the high-low range of the bar. Let's see, is it continue? Oh, wow. Now what happened on that bar? What happened there was you had a what's known as range expansion in the bar. That's a lot of buying coming in here. So that's really strong. Okay, what about the next day there? Oh, now you have a range compression bar. What if these are days? Monday, Tuesday, Wednesday, Thursday, Friday. You got a choice here. You can either carry it over the weekend with a stop in place, or if you got it somewhere down in here, you can sell it. Now, here we have an example of a downtrend, just real quickly here. And notice, of these two, despite the fact that it's going down, which would you rather have? Excuse me. Oops. Well, sorry about that, guys. Blew through our chart, but that's all right. Somehow it jumped. I was going to give you one other example. Real quickly, let me show you something here, because this we can learn from. What I was going to tell you is let me know when you think that you're going to get in a trade, and I was going to unveil these one bar at a time. Most people, when they see this bar, yeah, let's get in it, but that's a big mistake, because you need to take out this higher area up here. Whether it has other bars or support or not, you need to take that out. Then when there's a gap, people see this, they say, wow, I'll get in now. No, look at what it is. It's a gap with a range compressed bar. It shouldn't be compressed on a gap. It should in fact be expanded. This is a warning to you that a bullish scenario is highly likely, and sure enough, we got a big pullback went on here. And so price went on here, and then what happened? This is the first time that you really had a definitive strong trend. You had range expanded bars, closes above the midline of the high-low range, and you're moving absolutely in a bullish or an upward trend. And here we just simply divide it up, and it shows you support and resistance if you want to divide a chaotic price behavior. By the way, in MetaStock, if you have chaotic price behavior like you see here, one of the best things to bring organization to it and to really get a feel for it is to use a standard error channel on it. Let me repeat that, a standard error channel, and you'll find that in the drawing tools in MetaStock. All right, so I run TradingSchool.com. We train institutional traders and hedge fund traders and people like yourself to trade on a professional level. We're the oldest trading school in the United States, been around a long time. Here's the telephone number, which is 951-696-0512. Our email, you can see here, is info@tradingschool.com. And if you want to be trained by a professional that trains professionals to trade, please give us a shout out. And it's been my pleasure today to give you the presentation. I know we went a little bit over, but I think it was worth it. We had a lot to cover, And my presentation, again, is more about trading and looking at what's really going on at the present time, more than it was on indicators or other things within MetaStock. So again, I thank you very much, and Kelly, that'll be the end of the presentation.
Well, Robert, thank you very much. As I mentioned, everyone, it was it's always a pleasure to listen to Robert talk. He knows his stuff. I think you heard that today. So I encourage you to visit him at his website, tradingschool.com. And definitely, if you have any questions for us here at MetaStock, please let us know, or give Robert a call at his number as well. Thank you, everyone.